You're listening to the Unlocking Africa podcast.
I really saw the opportunity to help grow companies to invest, but also some of the downsides of what people weren't doing. We've invested and hired quite a lot of women. Very proud that 80% of our portfolio is women founded or run and help create jobs and grow businesses. Capital alone does not help companies grow, or rarely does. Southern Africa, where we invest, these small growing businesses find it particularly difficult to hire for, develop, retain the best and the brightest. Let's make things that we consume and need so that we're not importing them, that we're not sending those profits elsewhere. And then once the cash stays here, that is just a force multiplier in the economy as it stays and goes around.
Stay tuned as we bring you inspiring people who are unlocking Africa's economic potential. You're listening to the Unlocking Africa podcast with your host, Tessa Adamu.
Welcome to the Unlocking Africa podcast, where we find inspirational people who are doing inspirational things to unlock Africa's economic potential. Today, we have a very special guest, Brendan Mullen, who is co-founder and managing director of Secha Capital, a private equity company that invests in African SMEs that are looking to grow. Welcome to the podcast, Brendan. How are you?
I'm well. Thank you so much, Tristan. How are you?
I'm good, thank you. Great to have you on the podcast.
Pleasure to be here. I'm a big fan, as you know.
Yes. We've had many conversations and I'm looking forward to our conversation today. So, as you've listened to the podcast before, I always like to start from the beginning. So I was hoping you could introduce yourself and tell us a bit more about Brendan Mullen.
Sure. Not too much to share. I think Secha Capital is the more exciting part. So I'll be brief. I'm originally from Boston, Massachusetts, but I've been living in Johannesburg for the last 10 years. My partner is South African. We have two young boys, a 3-year-old and a 10-month-old. So outside of work, that keeps me pretty busy.
Fantastic. As we mentioned in the intro, you are the co-founder and managing director of Secha Capital. Can you tell us a bit more about the company, what you do, why you started it, and what you hope to achieve?
Absolutely. Secha Capital is a lower market impact growth capital fund in Southern Africa, employing an operator investor model, investing in traditional industries, making the green economy tech-enabled and or post-COVID transition. So I want to expand on that. Our operator investor model it's this unique human capital approach where we second a team member into the portfolio company for a year to execute what we call our sale value add framework. And thus it complements our growth equity check into these companies that are usually in large, boring, fragmented markets. So fundamentally, we believe that by being thesis driven and employing this operator investor model, we can back companies that do not risk survival for growth. What we want to achieve, it's financial returns and impact, primarily job creation and some gender lens as well.
Fantastic. So in the intro, you mentioned that you're originally from Boston in the United States. So why did you decide to move to South Africa and focus on private equity in Africa?
Yeah, it's a long journey, but I think a pretty clear through line. And I'd start with kind of my earliest memory was kind of impact investing. And that term was kind of redundant. My maternal grandfather's from Michigan, and they kind of led the way on divestment into apartheid South Africa. So I always kind of had respect and excitement for the power, both as a economic multiplier and for impact that finance could have. So I've spent the last 15 years, I guess, before Secha, or 10 years before Secha, and believe it or not, campaign politics, but then in a hedge fund, some U.S. venture capital, and then strategy consulting here. And the through line was always, learning. It was always exciting and being able to have an impact. And really, it's only gotten closer and closer to that. Starting at a hedge fund, which is pretty high level, but some of the bonds that we traded were pretty innovative and cool, to VC and helping some new climate tech startups. And then when I came over here with a consulting firm, with Bain and Company, I really saw the opportunity to help grow companies to invest, but also some of the downsides of what people weren't doing. So to me, it was actually, it's a pretty clear choice. If you want to do something that you're interested in, you think you have some skills in, but you also want to make an impact. I mean, this is my bullseye. Yes. There's actually kind of no gray here. This is where I can maximize my impact in the world while also doing what I genuinely enjoy. So pretty easy decision to make.
So you've given us great insight into your journey in private equity in Africa. So if we go back in terms of focusing on Secha Capital, what makes Secha Capital unique to other private equity companies in the African market?
This is always what we're talking about. We fundamentally believe that capital is commodified, right? So what makes us different? Before I answer that more explicitly, we really believe that we have the best talent stack around, that maybe we're in the top 80th percentile of a number of key capabilities, but maybe not the best in any one thing. And that's really what makes our team different. And that's what maybe gave us the confidence to start Secha Capital. So I should mention that, as you said, I'm a co-founder with Rashil Valab and Nambuso Kumbule.
Yes.
And we decided that if we're going to start a company, let's be very clear how we're different. So it's three main things. One, that operator investor model. And I'll expand on that, I'm sure, later. But we redirect the flow of high-powered human capital away from the multinationals into small growing businesses. Two is our pipeline and exits via differentiated sector focus and check size. So we're not necessarily investing where others are, and then we can create returns by investing at a different stage and crowding in different sorts of capital, like strategics, dividends, secondaries. And then thesis-driven portfolio diversification and non-winner take-all sectors. We don't rely on inbound companies coming to pitch to us. We really do the homework to get to know a sector up front and then create a thesis of what could work here. What is full potential? How do we win some market share here? And then we go and find those companies. So those are the three kind of characteristics of our day-to-day. And what does that result in? Two main things from a developmental perspective impact is that we've invested in and hired quite a lot of women. Very proud that 80% of our portfolio is women founded or run.
Oh, wow.
And then reducing the brain drain. A lot of these operator investors we hire, had job opportunities in the US and Europe. And so far we've given them an opportunity to stay in the country, get that entrepreneurial experience, get that finance experience, and help create jobs and grow businesses.
Fantastic. So you detailed there that what makes Secha Capital unique is your portfolio diversification, pipeline and exit, and also the operator investor model. So I was hoping we could kind of home in on the operator investor model. Can you give us a bit more detail regarding that in terms of how you deploy in Africa and some of the benefits you've seen?
Yeah, great. Thanks for asking. So let's start with why, kind of our theory of change around it.
Yes.
Well, it's pretty simple. Capital alone does not help companies grow, or rarely does. In Southern Africa, where we invest, these small growing businesses find it particularly difficult to hire, afford, develop, retain the best and the brightest. So we believe that by leveraging a recurring local resource, human capital, we can build in a new way, kind of internal instead of external, bottom up instead of top down.
Yes.
And focusing on repeatability instead of just scalability. So in terms of results, our first fund was a $5 million kind of proof of concept fund. And we invested in 10 companies. Each time we made that investment, we installed an operator investor into the company for 12 months. Sometimes they were the chief of staff, helping the CEO put out fires, sometimes COO, sometimes CMO. Oftentimes they would help set up sales teams, install new accounting software, make sure that we were maximizing our Google and Facebook ads.
Yes.
And the results have been great. We've created over 300 jobs across that portfolio. The average revenue growth across the company has been 8x. And very proud to say also because of that intimacy in our kind of agility, we didn't have a single layoff during COVID, and we've just grown since then. So we have definitely learned a lot. It was kind of a beta when we started it, but we have enough dots to make a line. And it's really, that's when the magic happens, when we get these high-powered human capital, usually take them from a consulting firm or a bank, and they're young. They're, I don't know, I think the average age has been like 25, 26.
Oh, wow.
And we have them work with these entrepreneurs that know their sector, but maybe aren't marketing experts or aren't accounting experts or don't have time to do the HR of making the new hires. That's really where the magic happens. And it's been successful thus far.
Brilliant. So prior to implementing the operator investor model, how did you identify that this model is suitable or needed in the African market?
Mm-hmm. So anecdotally, My experience in Nimbusos and Rashiels kind of created a strong answer first. I'll just speak for myself. So
Okay.
I mentioned I worked for a clean tech VC fund, and I worked there for a year. And they sent me to two different portfolio companies. One was that was doing really well, and one that wasn't. I stayed there for not a long time, to be honest, but 3 weeks for each of them, and just helped out because they didn't have a person. I think one case it was building a financial model, the other one it was kind of refining a partnership, and they just didn't have enough capacity, bandwidth, and they didn't have the right person to do that. So I was seconded to them. I loved it. That was so much more fun than just building models or just scouting for pipeline.
Yes.
And then when I came over here with Bain and Company, we worked with a lot of, some multinationals, but some medium-sized businesses. And then we didn't do anything different than the consulting firms do in the US and Europe. We made these beautiful PowerPoint decks and handed them off and said, now you go execute. And I didn't think that was a strong solution. I was very surprised that we didn't get a little bit more operational, or at least do some talent assessment or upskilling, what have you. And again, it's not because that talent doesn't exist here. It's because it's not distributed. The multinationals are here. So it is that much harder for these businesses to recruit these high-powered human capital people. So we had that theory of change, right? The returns, or I guess we then looked at the landscape, and the returns of private equity have not been good. So obviously you need to rethink. So as I mentioned earlier, we need to be counter-positioned. So why the low returns? Well, we think the check size, the sector focus, and the PE model was just not set up. So how can we rethink the PE model? Well, the operator investor. I think even more kind of philosophically, we're inspired by a term we like to use a lot with companies, biomimicry. It's a nature-inspired approach that seeks a sustainable solution to human challenges by emulating time-tested patterns and strategy in nature. So how can we apply some sort of biomimetic disruption to redesign African private equity? All right, write smaller but more impactful checks to a larger universe of small growing businesses, complement the financial capital with unique, high-powered, local-focused human capital, and bring repeatable, synergistic expertise to help grow the companies. And the results are a younger, more diverse operational team, more investments into women, and more investments into these kind of hidden, misunderstood sectors.
Thank you for that, Brendan. You've detailed your practical and operational experience, helped you identify that the operator-investor model was suitable for the African market, and also the value that it adds. So outside of this model, when investing in African SMEs, what value do you believe that you add, or Secha Capital adds, to those SMEs?
Yeah, most investors, understandably, they bring two things primarily: capital and a network. Now, our fund sizes are small, so we bring capital, but not a ton. And we are not the most networked people around. We're all right, but there's other people. So how else can we provide value? And again, maybe I should mention earlier, we borrow very heavily from the search fund model on the small end, kind of operational private equity on the larger end. And it's really making sure that we take the best of that and apply via this operator investor model and the sale framework, so that it's not just a PowerPoint slide. It's not just the map.
Yes.
It's actually helping. And sometimes there's that tension. We trust our entrepreneurs. They know their businesses much better than we do. So we don't want to get in their way and take away their time unless it's actually providing value. And we've really gotten it to be a lot more efficient and have a greater multiplier effect. And that really is making sure that caliber of human capital is something that they otherwise would not be able to attract with that operator investor. And then being very clear on where we intervene, how we help them, how we can upskill. And that has turned into the sale value add framework that strategize, assess, implement, and learn. Where we bring codified playbooks, we can bring some synergies, but ultimately it's, if our first few investments, we really focus on the what are we going to do? What is the strategy? Not just ambitions. What do we want to do? How are we going to achieve it? Just as important is the who's going to do this. And it can't just be the operator investor. It can't just be the CEO or management team. It's to be the full team. So when I mentioned that sale value add framework, the strategize is important. You need to know where you're going. You need to know how you're going to get there. But then the assess, who is going to do the what in order to get to that implement that. And then making sure that we learn from it, so that there is that sort of flywheel effect. So you get better, faster, stronger as you grow through that. And that's what we found, that this model really helps create growth. And the more we do it, we get better and faster at it. And then we apply those lessons from, portfolio company 5 to number 6. And then things we learn with 6, we bring back to portfolio company 3. Things like, managing cash flow, the accounting software implementation that I mentioned earlier, best places to hire a social media manager, how to incentivize a sales team, all those things we've now done a number of times, SKU range optimization, channel access, all these things become repeatable skill sets that you can bring to a team. It's really about kind of knowing a little bit and then the execution. And that's where we've been able to provide value to these portfolio companies.
Brilliant. Thank you for that. So you detailed the value that you add through capital, network, using the model and the sale value added framework. So before investing, how do you go about building your pipeline or scouting for investable companies?
Yeah, great question. Another area where I think we do differentiate, and we're very thesis driven. And that's an easy thing to say, harder to do. So we have a general kind of investment thesis and parameters and investment charter. But then each sector kind of has its own, what you have to believe, request for company almost. Like what does a good company look like in manufacturing, agribusiness, FMCG, business enabling services? And then we do a double click on that. And once we've identified a vertical or a specific type of company, we then try to build that fact base of what would this company look like. So it's very thesis driven in that regard, and evergreen as well. So we can come up with a thesis and not use it for a couple of years because these industries, this is not crypto or social networking. These are companies that are going to exist for a long time. The investment opportunity will exist for a long time. Obviously, I think crypto and social networking is here to stay. So let me give you an example. Our first investment was in Native Child's natural hair care for women of color, a niche growth vertical at the time adjacent to a larger market. So we really like that. It's since grown into its own very large market. That was a huge success. It has been a huge success still to this day. It's grown over 100x, issuing dividends. Wonderful.
Oh, wow.
And the more we learned at that space, and yeah, as your listeners can't see, I'm a white dude, right? So this is not an area I knew well. And a white dude, no sisters.
Yes.
But Nambuso, our co-founder, is a Black woman, and our team has enough diversity that we can understand these sectors that usually private equity people that historically look like me wouldn't understand. So when I first learned about natural hair care and learned about the difference between 3A and 4C hair, and
yes,
the trend to natural and the big chop, I was like, oh, all right. So I knew a little bit about wigs, or so I thought, but I had assumed that trend in natural hair care would make wigs, that market shrink. But no, I was very wrong. In fact, there is a correlation because you have natural hair care, but you don't feel like doing your hair in the morning. You're going to throw on a wig as an accessory, right? So now I know the difference between Peruvian and Brazilian, full frontal and 4x4. And we went out, we said, all right, the wig industry is huge and it's fragmented and there's not a lot of brand equity. Can we reinvigorate this market? And that's what brought us to our investment in Hairtown. We probably met with 5 different wig companies in that space and found one that wanted to do something that could have a D2C brand that could involve a celebrity, start building a brand, building trust. And that's been an excellent investment as well. We co-created with them Wukina as a business unit, which is kind of the Avon model for African wigs. That's really done well in the kind of more rural areas. And then we also built out Hair Majesty with a big celebrity here, DJ Sintele. Wow. And that's been taking off like crazy. I just opened a new store at Mall of Africa on Saturday. So that's kind of how we're looking at it. I guess as another example, I know I'm going a bit long, we invested in this company called Sure Fresh, which really took us a while to get our heads around industrialized ag. The hydroponics and environmentally controlled agriculture is not as risky as primary ag. And the more we got to know them and worked with them, we really saw the need for tracking and creating a platform for data across a farm. And so that's our next investment that's not public yet, but you could call it agri-tech, but this isn't drone. This isn't things we are interested in, like, soil health, which we think are exciting. This is pretty basic adoption of kind of your classic CRM, ERP systems that, happened 100 years ago in factories because they were, they're in cities and they were you could see everybody working there and you didn't have to worry about bandwidth and networks. So that we think that sort of tech adoption, I guess like lowercase t tech, is really coming to agriculture now. And there's so much in terms of low-hanging fruit there that you don't even need to get into all the kind of trendy machine learning stuff there. So that's a good way to, I guess, summarize how we are so thesis driven with two different examples.
Brilliant. So you mentioned that you're very thesis driven and touched upon what you look for in a company. I was hoping we can go into a bit more detail regarding that in terms of what KPIs, metrics or measures do you look at prior to investing in an African SME?
Sure. So I'll give them to you. I've always been reluctant to say a specific number of revenue, EBITDA, growth, GP, etc., because it really does differ. And I guess obviously growth rate involved in there, and then the kind of the bull bear case, right? If this is a company that has a recurring revenue that you just don't see disappearing, and a lot of customer diversity, and a lot of upside, you're a lot more excited to invest in that than a going concern that could maybe eke out 10-20% growth over the next 5 years. But generally, we look for domain expertise first and foremost, and founder product market impact fit. I guess in terms of KPIs, it kind of does vary on the sector. If FMCG, that GP has to be 60% plus. If it's manufacturing, you need to own a specific amount of the value chain and be able to play in different customer segmentations. But it really is what we look for more the way to frame the company within their market. And we really rely on kind of Hamilton Helmer's 7 powers quite a bit. So what we look for there are scale economies, network economies, counter positioning, switching costs, branding, cornered resources, or process power. And we really see, what is the key capability that will make this company work? Again, Native Child, that was our first fund. It was very small. It was a very small company. But we knew that she had branding power, and believe it or not, in FMCG, effectively network effects, because she had such passionate people. Whereas iGen, this battery storage company we invested in out of our second fund, you could say, well, all right, battery storage, how do you iGen take on Tesla? But we really realized that it is that kind of, in a way, cornered resource of technology is global, but energy is local. And they could design their batteries for the local customer. And that they had some of that process power and a little bit, I guess, of network economies, because they knew all the installers here. They were able to create that kind of cradle to grave solar plus storage offering much faster than a big conglomerate, going through a lot of the, I don't know if you've ever tried to put solar and, storage in your home, but it's a very tedious process. It's more like working with an electrician than it is, ordering something online on Amazon. So it was more about that. In both cases, I'd say they wouldn't fall into our standard metrics, which are, we look for 50 million Rand top line in revenue. What is that in dollars now? I don't know. We'll call it $5 million. It's not, but $5 million top line. And then usually break even or, 10% EBITDA. That's kind of our sweet spot. But again, I don't love putting numbers on it. And these are usually family-run businesses that see an opportunity for growth. And then again, I don't know if we'll talk about this, but I don't know that we would exist in this spot if debt wasn't so expensive on this continent. And so, that's why our equity is cheaper, because the cost of working capital or line of credit really is so expensive for a lot of these companies that have those cash conversion cycles or that are a little bit long, or that, their I guess unit economics are such that, it costs money to grow.
Thank you for that. I guess, as you mentioned at the beginning of your answer, the most important thing to look for is the key capabilities that will make the company work. So, the KPIs, metrics, and measures vary from sector to sector and depending on the company size as well. A previous conversation that we had, if I recall correctly, you mentioned that companies in the missing middle often offer great investment opportunities in Africa. I was hoping you could elaborate and explain what does that mean.
Absolutely. The bottlenecks are really only clear when you can see the whole system. And there seems to be a focus on the extremes in this market for VC and PE. It's either really exciting VC startups, which is great. Or if you have a PE fund, you raise a big fund so that you can deploy it into infrastructure and other things. And those are all good. I'm absolutely not going to say that they're not. But that leaves a big chasm, the valley of death, the missing middle, or as we like to call it, just lower mid-market private equity. And especially with the sector focus we have, that's where we see the opportunities. Again, inefficient market because of that. If people like to borrow from the US, and I think they're copying and pasting some Silicon Valley, I'd rather copy and paste lower mid-market, Midwestern private equity in the US. I really think that gives us a lot of lessons. That's where the markets are actually kind of similar to here in Southern Africa, where South Africa is, I know I listened to one of your podcasts, it can be the kind of the driver of the regional market that is Southern Africa, and each kind of area of Sub-Saharan Africa has that. So there's a number of reasons. Multi-factor is that's not, if you're able to raise a fund, you're not going to raise a 20, a 30, or $50 million fund and then be able to write a $1 or $2 or $3 million check into each company. You're going to raise a $200 fund, and then you're going to have to write a $20 million check. And now you can't invest in the missing middle, but then you're dying for pipeline. So if we can have the discipline to raise a fund size that can invest there and have patience and be able to bring follow-on capital, then we can set ourselves up as Secha to grow these companies to the stage where then they can grow into the larger, I'd say, deeper private equity pool.
Fantastic. So you've detailed there in terms of the opportunities in inefficient markets that you can help leverage and help grow these companies. So one thing which I did read is that you often look for sectors where South Africa can leverage local resources. Why is that?
Yeah, well, I guess for a few reasons. Number one is bits versus atoms.
Yes.
Which I guess leads into kind of local champions, and then kind of 3, knowing the local context, right? So we're not a tech investor. We don't invest in just bits. Primarily invest in atoms, things that you have to move or carry or make widgets. Now, if we can leverage bits as well, that's great. But that's where we see the opportunity. I had a friend a few years ago that he got laid off from his coding job, and he actually bought a snowplow business in Maine. I was like, why did you do that? He's like, they're not going to outsource the snowplow to China or to the Middle East. And yeah, that rings true. There's so many opportunities for these companies that the multinationals aren't going to be a major competitor. Or if they are, they don't have the local context. And therefore, they're so fragmented that you can build that local champion. So yeah, if I were in Silicon Valley, or a tech investor, obviously I'd have a different view. But that's not my lane. That's not how Secha is differentiated. So obviously you can succeed there. But where we see that opportunity is those atoms that need investment, and that can leverage bits to expand the metaphor even further.
So I guess this leads on to something which I read, which was Secha Capital invests or focuses on boring sectors and not technology companies. So maybe this is asking the same question, but I was hoping you could probably expand with regards to what you mean by boring sectors.
Yeah, I appreciate it. So I just want to be upfront. Boring is a bit cheeky, I'll admit. It's a bit of a marketing term.
It definitely caught my attention.
Yeah, but I think that's the idea. So it's a little bit more of a marketing thing. We never want to tell the entrepreneurs that their business is boring. But that don't get the front page. Another term we use is unsexy. Despite our last few investments kind of being kind of sexy sectors, and that would be, I guess, include the fourth, be agri-tech, renewables, and kind of a plant-based. I think we've done it in a very unsexy way. Again, by boring, maybe we mean like they don't have a burn rate. We're not investing just to buy them 12 months for the next raise.
Yes.
And again, we like saying boring because that's where we're counter-positioned. This is where we think we can get deals where we can buy early and create value, where execution can win the day. And these are also sectors that are heartbeat of the economy. They're economic multipliers and job creators. It's where that tech bridge and some sustainability solutions can go a long way for the bottom line. I guess another way, kind of borrow from the search fund investment world, go find me an industry that still uses a fax machine. That's where the opportunity is. I don't know that any of our portfolio companies use a fax machine per se, but that's where we see the market inefficiencies in terms of both returns and impact.
Fantastic, thank you. So you detailed what you mean by boring sectors and I guess the opportunities in those sectors. So if we look outside of the opportunities in terms of the importance, what is the importance of these boring sectors? What value do you believe that they add to African economies?
Number one is job creation. There's a lot of import substitution. We always like to say, for every native child hair care product or Rush nutrition bar, iGen battery, I guess I could go on, you buy, that's 50 Rand, 1,000 Rand that stays here that doesn't go off to a multinational in the US or Europe. So that really goes a long way. And then, it's a nice currency hedge. The more the Rand appreciates against the dollar, obviously that's not great for many things, but it makes exporting our products that much easier into the US and Europe. So it's really following the playbook of the US and Europe of 100 years ago in the way of economic expansion. Not that we're 100 years behind. It's let's make things that we consume and need so that we're not importing them, that we're not, sending those profits elsewhere. And then once the cash stays here, that is just a force multiplier in the economy as it stays and goes around. And I think there's something to having those locally grown African stories. I don't know that we're ever going to build the next Nike, but that when I mentioned Hair Majesty earlier, I'm very proud that that's an aspirational brand that is women owned and it's South African made. And it was supported by an operator investor that left, I think in this case, BCG, and she could have had a job in Europe. So I really, I think it all sort of fits together that this is the way to grow the economy. We wrote a piece in Stanford Social Innovation Review, Kuhle Manisi and I, and I'll be brief with it, but it was, let's not talk about another Marshall Plan. We need an arsenal of operator investors. So at the time of the Marshall Plan, the U.S., Roosevelt also did an arsenal of democracy, where he forced, Ford to start building airplanes and sent a ton of people to get it done, created a robust military machine, but also added to production capabilities and job creation. And that was all internal. And I think that's what I'm getting at for this. That's something that we can do here.
True.
These are the heartbeat of the GDP, of the economy, of formal and informal markets. And man, that's just the way to create economic development. I guess lastly, and it's tangible. It's really exciting to see Stoffelberg Biltong, one of our investments in the local grocery store, or to go find like a new franchise that's employing another 8 people down the street, and then having my 3-year-old son eat it.
Brilliant.
That's all pretty good.
Fantastic. Thank you for that, Brendan. So you detailed the importance of these boring sectors such as job creation, currency hedge, and exporting and growing the economy. So do you think that these sectors or types of companies are generally ignored within Africa or the Southern African market?
Short answer, and especially because I went long on the last couple of questions. Yeah. And I think that's what first started our conversation. I think the fixation on leapfrog, quote unquote, can be a bad thing. Again, I'm not saying entirely. I think there's amazing things with leapfrog technologies, but I think it's become a fixation of especially the capital providers to create a compelling narrative. And it's also not the headlines in other markets of where the money is being made. So yeah, I think that they are ignored. And then, I think sometimes then they fall into the bucket of social entrepreneurship, yes, which is also a good thing. But I think the definition of social entrepreneurship is not to have the private equity type returns. So I think that there's some overlap there. So you're either in one bucket or not, right? You're either in a unicorn or a social enterprise. And I think there's a lot of space in between.
I agree 100%. So you've explained there that these type of companies are ignored. So I guess stepping outside of Africa, as you are originally from the US, are you seeing US companies, private equity funds becoming more interested or exploring opportunities to invest in Africa from your perspective?
More interested, I guess, yes, but I'm not entirely bullish. And maybe now with the markets down, they might be chasing yield elsewhere. But we actually co-authored a paper last year with Duke University entitled Repitching the African Consumer Opportunity. And the insights were that people were, sure, they're interested. And especially when you kind of do that classic, like Africa, capital A, you add it all up. It's huge. The demographic dividend is coming. Look at all these consumers that are joining the middle class. And so people are interested. But, especially, the last few years in the equity markets or in alts in the US, it's just hard to justify them coming here from a return perspective. And then people that are seeking impact, there's things in the US as well. And then if you want to go emerging markets, LATAM is right down south. So we've seen more interest from the multinationals. We speak to some of them about kind of possibly acquiring some of our portfolio companies or investing in them. And then, getting that diversification. So we are working with a couple of asset consultants to create a fund of funds. We've talked to family offices that are particularly keen on the continent, but they generally need a connection. I don't see that as the FDI savior or what have you, especially since I think a lot of that interest is outsourced to the DFIs, whether it's DFC, USAID. So some interest, but no, I'm not seeing a massive change anytime soon. I think we're going to need to prove it to them to garner some more interest.
Okay, that's interesting. I know that there is a new US strategy towards Africa. So from your perspective, what do you think can be done to increase interest from the US to Africa?
Yeah, I mean, I'm not the expert here, though. I have strong interest from the geopolitical lens, and obviously speaking to people in the government, I guess both here and South Africa. So, outside of kind of geopolitics and, and world power stuff going on and recognizing what are we going to do with this population unless we grow the economies here, people respond to comparables, precedents, and superlatives. So I want Secha to do incredibly well financially, create a massive impact, and be replicable. It's not just because Namuso, Rashil, and I and the team are so great, or that we found a couple of diamonds in the rough and amazing companies. No, I think it's a very replicable opportunity to create returns and impact. So I think that's what we need to do in order to attract more investment attention from the US. And then there's obviously other structural things, currency, getting money in and out, education. Anytime they see a headline, whether it's in Burkina Faso, that's obviously nowhere near South Africa. There's that component. There's a lot of work to do there as well. But I think we're getting there. Obviously the fintech news of the last couple of years has been pretty great. That's, the first time I've had a lot of old colleagues reaching out to me asking about the opportunities. And so I guess the evolution is good. There's more capital coming in, more different types of capital. But like I said, people respond to precedents and superlatives. So let's start knocking out wins and proving that this is an opportunity to invest.
I agree. It is a slow and steady process. So stepping back into your domain of private equity, what are some of the challenges that you faced establishing, say, a fund that is focused on investing in African SMEs?
Yeah, so I think there can be with a lot of the LPs that are the standard LPs, there's a stigma around a quote-unquote SME fund. They say that's great for impact, but where are the returns coming from? Where are the exits? So one of the ways we did that with our first fund is say, hey, we're not necessarily looking for exits. That'd be great. But dividends and secondary sales are a great way to create returns for the fund. And we've proven that in a few instances. Now, what we're doing with Fund 2 is hopefully even better. So still that, we can still invest in these companies and you can make your investment return on dividends alone, but by virtue of that check size. But now we're speaking to much larger funds to be LPs or investors in our fund. So effectively, in a way, we become a discovery fund. These large funds are all looking for pipeline. That is not an issue an SME fund has. There's tons of great family-run businesses. So what if we have that huge pipeline, we grow these companies, help professionalize them, grow them up to a certain stage where those larger private equity funds are excited to invest in because it's a scarce asset at that point. They don't have a huge pipeline of which to choose from. So that's the challenge, but also the opportunity. It goes back to the question about missing middle. That is the bottleneck, I believe, that middle. And if we can bring those companies that are, that adolescent stage, help take them into adulthood where they're ready for the bigger funds, then that makes an even deeper and broader financial ecosystem.
Fantastic. So, the way you've evolved your first and second fund, was there a strategic reason or purpose or something that gave you an indication that that was the way to go?
Yes. So in terms of fund size, we just didn't have enough money for reserves out of our first fund. And granted, it was all high net worth individuals. It was via this thing called a 12J in South Africa, which is a tax break, really great public policy that's actually since sunset. And we were priced at a lot of deals in manufacturing and agribusinesses that needed a larger check than we could do. Our average check size in our first fund was about $250,000. Now it's closer to $750,000, $1 million, but we can go up to $4 million for some platform plays.
Okay.
And that's, that evolution is really, what we found in terms of those opportunities, that there's still a lot of pipeline even at that check size. And you could be a lot more strategic with convertible debt and things like that while holding on to that operator investor model, still investing in those quote unquote adolescent stage companies. But I will be honest, our first fund, since it was a 12J, it's technically a holding company. So technically a permanent capital vehicle. And we have acquiesced to the institutional LPs that our second fund is a 10-year 2 and 20, which, frankly, is not ideal. I can understand why they need it. As a fiduciary, respect it. But that's part of the evolution that we've done. And we decided not to, the operator investor model is different enough. So we didn't push back. And I'm happy that other people are. They're trying to create 20-year vehicles or things that are different than the 2 and 20. So for the listeners, I assume they know it. The classic PE model, LPGP model is you get 2% management fees, 20% carry on a 10-year fund.
Yeah.
And that 10 years, goes back to the earlier question about SME investing. Sometimes you need longer. So that's not an ideal in our world. We're hopefully going to do a 12-year fund, but if I could do anything, I would ask for a 20-year fund. But I also understand that's a long-term bet.
Yes.
To give for Secha. So hopefully more and more people will prove it out though. There's the most successful PE investors on this continent are the on-balance sheet investors out of family offices or big banks, but they're kind of private. They don't make that data public. So hopefully we'll start pushing that narrative. And that's one of the things I'm excited to see, right? That there are more funds kind of eschewing the classic model. It takes a long time to educate your prospective investors in the ecosystem that, to take that risk with something that's new and innovative.
Fantastic. So you detailed the evolution of your investment funds and the trends and indicators that steered you towards those changes. So if you look at trends, what current trends in Africa's private equity space are you currently excited about?
I think first and foremost, the gender lens focus. So maybe that is how we can kind of leapfrog, maybe not the standard definition.
Yes.
It's just so clear. And we found in our portfolio that there should be more women in private equity as investors. And we're proud to say, I think we're 80% of our team historically has been women. I'm just the American who likes to talk. So that's why I do a couple more podcasts.
Fantastic.
And I really think that is good just because it'll create more returns and make for a more equal system. And I think that I'm sure that there'll be some mistakes, but I just net really, really good. And I think we'll be ahead of other markets. And I think it's good for both returns and for impact. Like I said, I think some new vehicles coming out are pretty neat. Some new ways of structuring debt, structuring equity, some innovation there. We worked with a fund called WOMVEST, WOMVEST, that has an interesting way of doing impact-linked working capital debt, which we're pretty proud to see. And I think just generally, I guess what you said earlier, we don't go to too many conferences or anything like that, but it really does feel like we're just slowly moving the needle on kind of growing this ecosystem so that it's an economic multiplier. And again, we kind of assume this, but you have to believe that private equity is good for the economy. And obviously, you can do bad in terms of LBOs and cram downs. That's not the private equity we're speaking about. It's growth capital or even replacement capital. And so I do fundamentally believe that more private, lowercase private capital is a good thing, not having to rely on the banks necessarily or the liquid markets. So it's just more capital in this space. And hopefully, might get me into trouble, more capital providers that aren't just the development financial institutions. Again, they do great work, but you need a diversity of capital providers of different risk tolerances, different backgrounds to really fill out the ecosystem.
Thank you for that. So you detailed the trends in private equity that you're excited about, such as more women being involved in private equity in Africa, new vehicles of structuring debt and investment. So if we look at, the trends and going forward, where do you see Africa in 5 years' time from a private equity perspective?
Yeah, for fear of pitching my own book, but it is what I see. And I guess it's in private equity. Yeah, like more funds like Secha. It doesn't have to be a copycat, but in terms of check size and the value add, I think people are realizing that that's the way to win. And by win, I mean either financial returns and or impact. And by impact, I guess I mean job creation, gender lens. We can't just keep doing things the old way. A deeper secondary market. I really think, especially with, if you're limited by a 10-year fund, you need a secondary market. So again, for the listeners, it's So one fund sells their interest in a portfolio company to another fund. You can get more complicated than that, or you sell your entire fund. And then more platform plays. Maybe that's a little bit unique. So maybe it's a little bit recency bias and trendy, but we're really seeing a lot of opportunities to get scope and scale with platform plays. And I haven't seen a lot of that on the continent. We've spoken to a lot of funds in the US that have done a really good job of buying a bunch of small assets, bringing them together, or buying one and using that capital to buy up some others. I really think that could be the future. And more local institutional capital, pension funds and endowments on the continent and locally we're seeing are starting to get interested in alts. And that's a good thing. Again, I think I might be pitching my book and being selfish with this. Where do we see it? But hopefully, that's a rising tide that lifts all boats, not just the world of Secha.
Fantastic. Thank you for that. So, if we look closer to home, where do you see yourself and Secha Capital in 5 years' time?
Yeah, in 5 years' time, we should be on Fund 3.
Brilliant.
And why is that? It's not just to add AUM, but as I said earlier, we like replicability and effectiveness over scalability. So following that kind of biomimicry framework, we really believe that this is a model that you can bring anywhere. Obviously, the risk return might change, but we're big believers in this operator investor model. And so we would like to apply it into more regions, whether that's, Nambusa or Rashil and me running it or somebody else, that's fine. But I really think, especially in emerging markets, any place where there are multinationals that kind of hollow out that management gap or steal the best and the brightest, like anywhere we can redirect that human capital flow, that's the kind of human capital arbitrage opportunity that I see being very replicable. So yeah, I think 5 years from now, we should be on our third fund. I guess 5 years in, we've deployed most of our capital from Fund 2. So I would have liked then should be 10 investments in Fund 2, like 75% of them to be women. Hopefully we should have created in 5 years. I want to be at least 200 jobs across those, probably more. That's what I'd like to see. So maybe I'll listen to this in 5 years and do a check.
Well, hopefully we'll get you back on in 5 years' time so we can have a conversation and see how things have progressed.
Oh, that'd be great.
But no, thank you for sharing that, Brendan. That's a great vision and one that I look forward to seeing and keeping a close eye on.
Quote of the week.
As people, we often have quotes, mantras, proverbs, or affirmations that keep us going when times are good or when times are challenging. Do you have one that you can share with us today?
Yeah, and I love this part. I'm a big fan of quotes.
Brilliant.
I have many, but I decided to go with a pretty basic one. Just love the journey, not the destination.
Mm-hmm.
And there's so many different ways that could either be Viktor Frankl, that's from the poem Ithaca, that's Homer in the Odyssey. Just keeping the destination in mind is important, but you get there faster, you do a better job getting there if you enjoyed the journey. And that's pretty important to me. And I was a classics major, believe it or not, in undergrad.
Oh, wow.
And then even at my Jesuit high school, we had to read the Odyssey. And one of the reasons I like it is I think of Odysseus, right? And he had been gone for 20 years, 10 years fighting, and then 10 years traveling the world. And went on all these adventures, and he's trying to get home to his wife and his child back to Ithaca. And now as he's almost there, he's like, wow, I really wasn't living in the moment. I just had these 19, 20 years of amazing adventures and so on and so forth. And if I knew I was going to make it back home, I would have enjoyed it a lot more. So I try to think that way. The destination is pretty awesome. He was going to see his wife and kid. I think the future of Secha and PE in Africa is pretty exciting. But as we go along, there's still a lot of great things while you do it. And even enjoying the tough days is an important thing to keep in mind. So, I think it's a little trite at first glance, but that's a quote that I do find a lot of wisdom in.
Oh, I love that one. Thank you. And I've just realized we share another piece of common ground. I was also a Jesuit schoolboy.
Oh, there you go. I knew that's why we hit it off.
St. Francis of Xavier.
Okay, great. So I'm Boston College High School in Dorchester, Massachusetts.
Oh, fantastic.
I'm not even Catholic, but I really like the Jesuit education. I'm a big believer in many of its values, but maybe that's another.
That's a different conversation. That's probably for the next episode 2. So as we're coming to the close of the conversation, I was hoping that you'd share some closing remarks and final calls to action for anyone who's interested in Secha Capital or just interested in private equity in Africa.
Yeah, well, I guess closing remarks. Thank you for inviting me on and for doing this podcast. I really think you have a great diversity of guests and opinions, and that's important. There's not always room for more than one narrative.
Yes.
Especially in quote unquote capital A Africa, the country of Africa, whatever it's called. But and a lot of people are doing great things, and they can be right even if we're in different lanes. But I guess for myself, yeah, please reach out if anybody's interested in, especially kind of the operator investor model and learning more about where it comes from, whether it's kind of search funds and entrepreneurship through acquisition, or on the other side, kind of operating partner private equity. And if any of this resonates with you, love to speak, love to expand this thing, starting a fund in a different market. We'd love to share our lessons learned, what we've done right, what we've done wrong. So feel free to email me at brendan@sechacapital.com. Hit me up on LinkedIn. Very easy. I'm a big LinkedIn fan. I like following people. I like posts that they do up there. On Twitter, any of the above. So it's just look me up on LinkedIn, Secha Capital, Brendan Mullen. I think it's probably spelled on there, but always nice to speak to other people that are out there with a similar mindset or that may disagree, because always good to learn from other people that have tried these things before or have good insights.
Definitely. Thank you, Brendan. That has been an extremely enjoyable, insightful, and educational conversation. I've taken away a lot of information from our conversation today. Really enjoyed it. So thank you for joining us today. Thank you for taking your time out.
Thank you, and happy birthday.
Thank you. I'm not going to reveal my age, but I'm not 21 and I'm not turning 50 either. So, so just somewhere in between that. So yeah, it's been a great conversation and look forward to more conversations and collaborations in the future.
Same. Cheers.
Thank you to everyone who has listened and stayed tuned to the podcast. If you've enjoyed this episode, please subscribe, share, or tell a friend about it. You can also rate, review us in Apple Podcasts or wherever you download your podcast. Thank you, and see you next week for the Unlocking Africa podcast.